All right, everybody. It's 4:04. Thank you for joining again. We really do appreciate it. So I'm Brandon McKnight. I am the Chief Strategy Officer here at Pine Financial Group. And we got Kevin Amolsch, who is our CEO and founder. And tonight we're actually going to be talking about our latest mortgage fund, PFG Fund 5. It's a $75 million fund. And one of the reasons we wanted to do this is actually we've been getting a lot of inquiries on a one-off basis with people with questions just wanting to know more. And so we thought we would put together something where it gave everybody an opportunity to just, learn about the fund. I'm going to do a quick housekeeping rules here. So we're going to be talking about the fund. We definitely want to get your questions. We got some questions even before we started. So I've got some via email. So what I'm going to do is I'm going to ask if everybody can kind of either put their questions in the chat, just so we can let Kevin get through most of his material, and then we'll try and start tackling those questions one off. And then the last thing I wanted to share is that we are recording this tonight. So I want to let everybody know out there that this is recorded. We don't typically do that, but we felt like this was an opportunity for us to make sure we get a lot of different questions and kind of address some of these things that we hear on a very frequent basis. So again, I just want to say thank you for joining us tonight. And Kevin, I don't know if you want me to go ahead and jump into more details about the fund, or if you want to just go ahead and jump in. You tell me.
Yeah, I guess. We didn't think about that one, did we?
Yeah.
I guess let's just jump in.
You are so used to doing this, right?
Yeah, let's just jump in.
Okay. All right, I will make you the host.
All right, let's see if I could do the screen share here. There we go. Okay, does everybody see the PowerPoint here?
Looking good.
Yes.
All right, fantastic. First of all, I want to say thank you so much for all of you for joining me tonight. It's a nice and warm evening. I know a lot of you are in Colorado and wherever you're coming from. I really appreciate you spending your time with us. I know there's lots of other things you could be doing, and you chose to be here. And what Brandon and I are absolutely committed to is giving you the information that you're looking for, and we're going to stick around to make sure we have all of your questions answered. So type those things in the chat, and we'll make sure we get every single one answered. We're not leaving until that happens. So I'm just going to go in quickly here because there's a lot to cover, and I really want to try to keep this to the hour, or actually less if we can. So what we're going to talk about today is private lending, our management team, the mission, advantages of considering PFG Fund 5. I want to talk a little bit about the economy. I went back and forth on whether we should go over this, but I know there's a lot of concern and fear of what's going on right now. So I want to cover that. And I want to absolutely take your questions on how we are interpreting the economy now, and then exactly what to do to make this investment. So private lending, what is private lending? It's very simple. It's just an individual making a loan to another individual on its simplest explanation of that. But for us, private lending is our fund, or one of our funds, making loans to real estate developers. Now, there's specific reasons that we want to make loans to developers and real estate investors and not individual. And it has to do with regulation. So if we could stay out of the consumer lending, we could stay really safe. And then by loaning to real estate investors, we're able to secure this investment. So we could make sure we get our money back, our investment back. So it's mostly residential rehab or new construction projects, but we are doing some commercial as well, which we'll talk about. So what does a typical private money loan look like from our view or out of our lens? So the deal structure is like this. We're always in a first position deed of trust or mortgage. That gives us the protection. If there's a default for whatever reason, we're going to be the ones to get paid back before anybody else. And we charge 2 to 4% in fees. These are called points. 1 point is 1% in a lender fee. So think about $100,000 loan. If we make a loan to somebody for $100,000 and we charge 2 points, it's $2,000 in fees. That's something that Pine Financial Group retains to help us pay our sales team and cover our overhead. And then our rates are high. They're 10 to 12%, which actually isn't looking as high as it once did with all the interest rates going through the roof. We literally just talked about prime and the prime rate before I walked into this room. And it's a staggering, like, what was it, Brandon, 8 or 7.5%? I didn't look this up before we got on the call, but I think he said 7.5% prime. So hard money loans and private money loan interest rates aren't looking so bad. And then we typically will do a 9-month term. Now we'll extend this out if we have to. We really want to make loans that benefit our client. So if they're doing a new construction project and it's in the city of Denver, for example, we know it's going to take them a little bit of time to get through the city approval process. So we're going to extend our loan to make sure that they're successful. But in most cases, especially on fix and flips, we're at 9 months or less. And that's a big advantage to keeping your money safe, because as the economy changes or as somebody's personal economy changes, the quicker we can be in and out of a project, we can reduce our risk. So we really want these loans in and out as quickly as possible. Let's go through a real quick example. This is an actual example of a deal we funded in St. Paul. Yeah, I did round the numbers to make it a bit more simple to understand. But we loaned 70% of the ARV after repaired value. And then we release all the funds for construction in draws, and we're making sure we're inspecting the property. We're getting the photos and the inspection reports and releasing only for work that has been completed. And our appraisal on this one came in at 320. So our loan was $224,000. Total needed to close was 238 in this example. Purchase, repairs, closing costs. Those are the 3 numbers that you combine to come up with an acquisition number that you would see on your settlement sheet when you're going to actually close. So when you add those 3 up, it came to 238. So you could see he needed to bring a little bit of money to closing, $14,000 to closing to get this deal done. It took him 3 months to complete. This is one of our really regular clients. He's doing lots of projects with us. He's got crews and teams, and so he can get in and out of projects extremely fast. Okay, we charged 2 points and 12.9% was the interest rate on this loan. Here's a couple of real quick photos. You can see what he's doing. Out in Minnesota, you can see that the attics, they do a lot of attic finishes out there, and you see the remodel kitchen. So this is what we're so proud of. We're funding projects that are rehabbing properties and rehabbing neighborhoods and improving them. So why would anybody pay, in this example, 12.9%? That's ridiculous. It's such a high interest rate. Why would they do that? Well, banks are hard to borrow from. I wanted to put this, I love this chart here. It's the Mortgage Credit Availability Index, and it comes from the Mortgage Bankers Association. So you could get right on their website and pull this off. But I find it very interesting that, and let me actually break this down a little bit more for you. The Mortgage Credit Availability Index takes into account pricing, one, which is it's not as relevant as the underwriting guidelines, but it does look at both. So think about like down payment requirements, credit score requirements, those types of things will reduce the availability of credit. So you can see leading up to the credit crash in 2008, how ridiculously easy credit was. And then obviously with the crash, it came way down. And then we haven't seen it really pop up since the credit crash. I mean, it was on an upward trajectory here and then fell during COVID. But you can see how low and how hard it is to get loans from banks. Large down payment requirements, high credit scores. They have global cash flow requirements. A lot of real estate investors they have trouble qualifying for that type of loan. We take a common sense approach to underwriting. If you could paint the picture of how you're going to pay the loan back and it makes sense to us, then we would like to work with you. We don't have very strict stay in the box guidelines. If it makes sense, we feel comfortable we're going to get paid back. We want to do the loan. And I can tell you our default rate is significantly less than FHA, VA, conventional, and banks. So we have a super low default rate. So properties need work. I teach classes, live events, I say live, this is live too, but in-person events. And I'll say, well, what lender in here would do this project? And I'll put up a photo of a dilapidated house, let's say, not habitable. And I'd ask, well, how many people in the room are lenders, were lenders, want to be lenders, bankers, any of that? A couple of hands go up. Okay, leave your hand up if you could finance this house. And without exception, all the hands fall down. And the reason for that is habitability. Conventional lenders and banks, unless you're a small community type bank, they don't want non-habitable houses. They want houses they can rent out right now if they have to cash flow. So they deny any loan that a appraiser marks as not habitable. And it could be something so ridiculous as not having a stove in the property, because a stove, you need to have a way to cook food to have a house habitable. So I've had situations where literally a stove not in the property made the house not habitable and not bankable. And look, we finance fix and flip, so none of the houses are pretty when we finance them. Higher leverage, which we're going to talk about more, but look, real estate investors want to do volume. They're trying to scale. They're trying to make money. They make money by doing deals. So if they're putting all of their money into one deal, they might be limited to one, maybe two a year. Money's finite. It runs out. But if you could leverage up a little bit, you can make it so you could do multiple deals. So a lot of investors will come to us just because they're able to do multiple projects with us when they might be limited to one or two with banks. Going back to our same example here, we talk about leverage. So they actually sold it for $325, close to that. And if you remember, we appraised it at $320. So they sold it a tad higher than we were expecting. They bought it for $171,000. So all I'm doing is taking the amount they sold it for, and I'm going to subtract all of their expenses. They had closing costs of $7,300. That paid us, that paid Pine Financial for our lender fees, and then it also covered title fees. $59,000, almost $60,000 in construction. Again, it only took him 3 months, right? So this was super fast, in and out. Holding costs, this includes your interest payment to us, which is how we pay you your interest. It covers utilities, taxes, and insurance. And then the selling fees, so realtor fees and title fees. Again, you got to pay title fees when you buy it. You got to pay title fees when you sell it. And so your profit, almost $60,000. Now, the way his return looks, $14,000 in, $9,020 in interest, insurance, and utilities. Taxes I took out of there because that never actually came out of his pocket. So this was pretty close to the accurate number here. Total of $22,875. So if you take his profit, you divide it by his investment, you can see a 257% return on his money. This is leverage. This is why the main reason that we see real estate investors want to come to us for financing. So why would anybody pay these high rates? Yeah, we're still talking about that. Ease of the draw process. Banks take forever for everything. These investors need to pay their subcontractors. They need to pay their contractors, their painter, their tile guy. And I've seen contractors walk off of job sites for not getting paid. So if we could speed that process up, keep that cash flow going, it really helps the real estate investor be successful. So we've focused we've spent a lot of energy and a lot of focus on our draw process and making it easy. In-house underwriting and servicing. So this is where they could call us up and talk to the decision maker. They could call us up when they have a problem, and somebody here can help. We have a small firm. We're only 12 people right now. We have outstanding customer service. That's how we separate ourselves from our competitors, and our borrowers love it. And that's why we have such a high repeat. So the management team, quickly, I'm Kevin Amolsch, the founder of Pine Financial. I do say I'm an Army veteran. Some people think that's important. We're a veteran-owned company. Finance degree, I got my degree in Denver in finance while I was investing in real estate. Actually, I was working on that. I've been doing real estate investing, fix and flips, wholesales, rental properties, lots of owner financing and creative financing. I've been doing it for 2 decades. And what I learned through that process is I really love the deal structure, and the financing side of real estate is the deal structure. So I really honed in on the financing side and tried to become an expert on that. And I've been doing the private money lending for 16 years. Started in 2006 with a partner. We dissolved in 2008. She wanted to go teach real estate instead of do real estate. I like doing real estate, so I decided to start Pine Financial in 2008. I'm the author of the 45-Day Investor, which I'm very, very proud of. It went to #1 on Amazon, and I get invited to speak sometimes across the country. So that's a lot of fun. We brought in Jared Steinberg several years ago. I wanted to build a leadership team. For so long, it was just me. And so I wanted to bring in some people that know how to run a company and know the processes that we need to do to be successful. So we brought in Jared. He's our COO and general counsel. So he's a licensed attorney, graduated from CU, president of his class. And then he ran a debt collection business. He calls it a debt buying business, which it was. He bought debt and then he collected on debt. But what I think is so attractive about that is the debt collection piece. Like, he really understands when we have defaults. He knows how to manage those defaults and how to collect on them. So vital to the success of a lending company. And he's done quite a bit of real estate developments himself. Him and I have partnered on many. So he's a successful real estate investor as well. And since we have Brandon on the webinar tonight, I'm going to let him tell you a little bit about himself.
Yeah, thanks, Kevin. I appreciate it. So Brandon McKnight, actually, I joined the company a little over 90 days ago. So I'm the chief strategy officer here. And part of my mission is really just to help grow the company and assist Jared and Kevin with kind of, some of the investor relations and accounting and finances and all those things. And a little bit of background about me. I actually spent 7 years at IBM. Actually working as a part of their anti-money laundering group. So I had a team of approximately 1,500 people at that point, with global offices in Krakow, India, as well as Canada. And then before that, I was with Stewart Lender Services and ran their loan file review division. So lots of experience with REO asset management, loan origination QC, servicing QC. So kind of bringing a lot of the different things I've done in my career here to just try and help grow it, and super excited. And as you guys start, looking at investing in the fund, I'm going to be your primary point of contact. So excited to get to know all of you a little bit better.
Yeah, thank you, Brandon. I just want to say I'm so happy that you decided to join this amazing team. Him and I met a couple of years ago, and I loved his resume. I loved everything about him, and made him an offer, and you turned me down, didn't you?
Tell everybody that.
But you know what? We just kept at it, and here we are. So we're doing something special. And thank you for
thank you. Happy to be here.
All right. So our mission as a company, well, I think it starts with the mission statement. This has been our statement since day one. Every prospectus, if you guys have seen the prospectus, you've seen this. We provide high yield investments while supporting the community through property rehabilitation. But what exactly are we doing? So number one, without exception, before anything else, capital preservation. It's been that way since day one. And that's why our default rate is so low, because we don't make loans that don't make sense. And we're very aggressive with our loan servicing. So if there's a problem, we jump on it immediately. So capital preservation, number one. Bring stability to an investment portfolio. And look, we need that right now. We're going to talk a little bit about the economy, but the stock market went from its high to its low over 25% in this year alone. That's not stable. Pay a fair return. We want to pay you a fair return. And we're proud of this one as well. It's liquid and there's no fees. We make our money, which we'll talk about in a minute, mostly from our fees we charge our borrowers, but also the spread between what we're able to collect on the loans and what we're paying you. And then we support our community. So we have 4 organizations that are our primary. We donate time and money to these organizations. There's several others like our kids' schools and that type of thing, but we really pour into these ones. The Boys and Girls Club, Project 127, which is helping families foster kids. Toys for Tots, you probably know, and Feeding America. And maybe outside of Feeding America, you probably see a theme, and it's kids. We just have a passion for kids, so we're happy to support that. Okay, how do we preserve your capital? It starts, like I said, with the underwriting. We limit our loans to 70% of the value. We have liquidity requirements. A minimum liquidity requirement is 10% of the loan amount, and it goes up from there depending on maybe lower credit scores or income, or if it's a more risky loan, we would have more liquidity required. So let's say it's a $200,000 loan, we would require $20,000 to be set aside into an account that's liquid that they could access if they get themselves into any trouble. This is how we keep our clients safe. 70% loan to value helps keep us safe. This keeps our clients safe. We also look at credit requirements. We look at credit. We have credit requirements. I call it a stress test. Some people call it a profitability test, but we run a deal through our calculator, make sure it's going to be enough profit to be comfortable, a little cushion there. We want to make sure it's a profitable deal for our clients. And then we require personal guarantees on every loan. So not only is the real estate itself collateral that we can go after to recoup our investment, but their entire balance sheet is collateral. We could pursue personal guarantees on every loan we do. Diversification. If you're invested today, you would be invested in over 60 loans worth over 50 million, and that's in this fund alone. We have over 130 million in assets under management today. Over 50 of that is in this fund. The combined loan to value, again, getting back to how are we staying safe? Combined, if you look at the entire portfolio, it's under 60% of the collateral value. And then Brandon helped me put this together. You said five different loan types and 6 different locations. It loss reserves, industry standard is 50 basis points. 100 basis points is 1%. So basis points, we don't use that term as much on the residential side, but in finance, you use it a lot. So that's 0.5%. So half of a percent on assets under management is standard for set aside in a money market account, very safe, very liquid. We keep at least 75. So we've increased what we need. Foreclosures, senior position, we talked about that. We're always in a senior position and a low loan to value. This is how, if we have to foreclose, which we do have to do sometimes, we could sell that property and get our investment back. Twice a year reporting with audited financials. So not only are we being very careful with our financials, we have a third-party accountant do our GAAP financials, general accepted accounting principles. That's what's required for the government. So we have a separate CPA, aside from our tax return CPA, do the GAAP financials. And then we have a full audit every single year, 2 times a year reporting. So you can, public record, you could just get on there and look at all of finances and everything. Retained earnings. Now I've debated putting this one in there or not, but the way this works is there's a private note on your investment is going to be a note, and meaning you're a creditor. Creditors get paid first. That's why for me and our investments that we choose to make is always loans. We don't invest in an equity position or a partnership deal with our clients. We're always in the creditor position because that's the safest one. In this investment, Fund 5, you would be a creditor to the fund, so you would get paid first. The reason that's important is because we're not taking any profits out of Fund 5 right now. Now, we plan to once we hit a certain threshold on the retained earnings, but we want to build up that equity stack so that if there's losses that start to accrue, then it would go into the equity before it ever hit our private investors. All right, how are we compensated? All right, Jared just gave me a quick note here. There's people in the waiting room, I guess. Can you check that real quick? All right, how are we compensated? We talked about it. We charge our borrowers fees, 2 to 4 points of fees. We charge servicing fees. Now, these servicing fees are not being charged on this fund specifically, but I just wanted to be real transparent. And our other funds, we charge a servicing fee, and we charge our private note buyers. We do sell notes occasionally to individual investors, and we charge them a servicing fee as well. So that's just a fee to collect the payments, do the tax forms, manage the default if there is one. And then finally, this fund this is more specific to this fund. There's a spread. So we charge 12-ish% on our notes. We pay you 8%. So you can see that 4%. Now it's not all loaned out all the time. So sometimes we have money sitting in the account that we're paying 8% on, earning nothing. So it's not like the full 4% all the time, but there is a nice little spread there to compensate us for this. All right, investor advantages. So these are this is telling me it's in the waiting room now. So let me see if I can let them in. Okay, sorry guys. There's a way to work on as we go through this. Next time, share the screen without being the host. Okay, got him in. And Brandon, can you see the waiting room by chance?
I can't. That's what I was trying to let him in for you, but
if you could, I was gonna say if you could let me know if someone's in there, but
yeah,
maybe Jared will keep doing that for me. Okay, so advantages to this investment for you. We talked about this. There's no fees. So when we say you're going to get 8%, you're going to get 8%. There's no fees at all. No fees to enter, no fees to exit, no fees to manage. No lockup period. So if you're, we've had a handful of investors recently ask for their money back because they think that there's more real estate opportunities coming and they want to be prepared for that. Okay. I like this steady 8% while we're going through this economy, but they're looking for maybe opportunities. So they requested their money back. Pretty rare, but we do see that. You could choose income or growth. Income would be, hey, every single month you get a direct deposit into your checking account. Log in, you see it every month, or growth. Now you only get a statement once a quarter, so you won't see that every month, but it will be accruing every month. So every month we run a distribution, you just reinvest your interest back into the fund, and then you're earning interest on interest, which is, as Einstein would say, the eighth wonder of the world, compound interest. We have a proven team, A+ BBB rating, and I don't know if we've looked at this, maybe Brandon knows, but we've won however many gold stars for absolutely no complaints. We've never had a complaint on BBB. In fact, we've never had a complaint on anything. 5 stars with bigger pockets, 4.8 with Google reviews. You could Google us and Google Pine reviews or Kevin, my name, and reviews or complaints or any of that, and you won't find anything. Diversification, you are diversified in this investment. So Brandon, thank you so much for putting this amazing little pie chart together for us.
Yeah.
So this is the current portfolio. We have 76% residential, 14% approximately commercial, and almost 8% in land. And that land is shrinking. So we've implemented some new guidelines to even further restrict land investments. I mean, the reason for that is you can't produce cash flow with them. So if everything just falls apart, like some people call me, tell me, well, what if the world ends? Well, I could rent out houses and I could rent out commercial space, but I can't rent out land. So that makes it hard for me to generate income to pay the 8%. That's why we keep a real small portion of it in land and like the commercial and residential. Now our target is more of a, well, I guess we're pretty close, but we want to target about 80% residential. And the reason for that is it's much more liquid. So not only can I rent it out if I need to, but if I need to sell it and offload it, I could sell a house much faster than I could sell a warehouse for example. And then we have one little REO property that equals 1.6% of the portfolio. And Jared tells me that this one's under contract and should close by the end of the year. So that will be a 0 defaults in the fund by the end of the year. At least that's what we're expecting. All right, it's stable. We really want to provide one of the mission, right? We want to provide stability. So this is a promised return. It's not your home run investment. I don't think you're on this call looking for the home run. This is something that's going to be very consistent. You can count on every single month. And then a big advantage that really does separate us from most of our competitors, because we do have competitors in the space doing something very similar. But this fund, because we went to the effort to make it public, we got all the approvals with the SEC to offer this publicly. We could advertise for it. I'm allowed to do a webinar just like this and tell you I'm going to pay you 8%. But I could also accept investments from non-accredited investors. So this is something that a lot of non-accredited investors would not have access to if we didn't go through that process. Most of these types of funds are accredited investors only. And we could talk about accredited versus non-accredited if you like. So ask the question if you want to know more about that. I just put this in here because I thought it was kind of funny when you look at the S&P. The S&P is the 500 largest companies compared to our fund, and you can see very stable. This was over the last, 20 years or something. Now, this one I find interesting. So I compared the S&P over the last 20 years to what if you invested in an 8% fund and reinvested. So the compound interest where it's going to grow instead of the income. And you can see this yellow line, the effect of the compound and how it's exponential. Exponential just means it's getting more and more steep as you travel through time. So you can see this will really shoot up if you give it enough time. And then the stock market, it started off okay, fell, and then for all of these years, looks like maybe 10, 12 years, it wasn't performing an 8% return. The 8% return outperformed all of this time. And then you had the run up and of course the crash recently. So this is, I mean, I think it's a very interesting graph, just because you could see the exponential growth in it, even at 8%. All right, the economy. This is what a lot of you have probably been waiting for. It's not great. We know that. We're either in a recession or headed that way. I happen to believe we are in a recession. When I learned finance in college, they talked about GDP and the lack of GDP growth causing the recession, or being the indicator of the recession. Now, there is no clear indicator of recession. We're told we're not in a recession because unemployment is so low, although we're starting to see that creep up finally. So inflation remains high. This is what is causing the recession. Inflation is so high that the Federal Reserve wants to fight that, and they're going to do whatever it takes to get that down. They have a target of 2%. I honestly don't think we get there, but right now 7.1 is way too high. So that's what's creating this problem, and they're fighting inflation by rising interest rates. So I just looked today. About 6.5 is the 30-year fixed rate loan. So that's the average this morning. It's probably already changed a little bit because that thing is constantly moving around. Reduced transactions. So home sales are down 37% home sales. So this is a number that scares a lot of people. We are seeing some softening. When I say softening, I'm talking about prices reduce. Year over year, though, and this is nationally, is still up 2.9. I do think I hear that from economists and experts like, hey, we're still up. Yeah, that is true. Year over year, we're up, but we had such a big run up at the beginning of the year. It doesn't mean that we haven't lost some value in recent months. So we have seen that. Stocks are down. I mentioned this from the top to the peak to the bottom, over 25% in this year alone. And then there's panic in the media. So what do I look at? I really rely on the fundamentals of the economy. And the fundamentals come down to two things: supply, demand. So when you look at supply and demand, the best way to look at that in housing is months of inventory. And the reason I say that is it accounts for both supply and demand. So it takes into account both in one matrix or one number. Now, an average or a stable months of inventory number is somewhere between 4 and 5%. I've heard a lot of realtors tell me it's 5 months. It might be even higher than that, somewhere tell me. But when you look at the graphs, you really can see that it's between 4 and 5, maybe 5.5 months or so is neutral. So if you think about neutral, let's just say it's 4 months. Let's say 4 months is neutral. Any amount above that is going to become a buyer's market. So that's when you're going to start seeing inventory increasing, pricing coming down. Anything below that is typically when you see appreciation, seller's market, tougher on the buyers. So these are the numbers in our two primary markets. Over 95% of our loans in this fund are going into one of these two markets. So Colorado, 1.7 months, Minnesota is 1.9, and this is November numbers. October was actually, Minnesota was lower than Colorado. So Minnesota bumped up a little bit here. But as of November, you could see the low months of inventory still. Building is way down. I looked at this statistic over these two regions. You can get these statistics by region. It was a little tougher for me to get it by state. But in the Midwest and the West, those two regions are the two markets that we're lending in. Down 11% and down 10.6% respectively. These are big numbers, you guys. So the home builders are reducing new starts by this, meaning that the inventory coming in the next, I don't know, 5, 6, 7 months. That's about how long it takes them to crank out these production type homes. It's not going to be there. They're just not building. They're not keeping up. I have no stats on this, but I have a strong belief that low rates are keeping people in their homes. They're not moving out. Why would you move out of a home and put it on the market for sale when you're at a 3% interest rate? And also the pent up demand. Look, I have money sitting on the sideline wanting to invest in property. I want rental properties. People I talk to pretty much every day want rental properties, but they're waiting for prices to come down. We have big institutional investors like Blackstone. We've all heard of them, the largest home buyer in the country, on the sideline waiting for prices to come down. All of that pent up demand, I think, will create a floor for home prices. As the prices of the houses come down and it hits a certain number, dollars are going to start entering the market, and it's going to keep those values elevated. Again, I have no stats for that, but I do believe that that's real. Mortgage rates should be coming down. Now, there's many reasons for this, but I put a few up here. December, we saw a reduction in the increases on the short-term rate by the Fed. So it was a 0.5% or 50 basis points increase in December. And we've been seeing 75 basis points for multiple committee meetings, and this one was lower. And the expectation is about 75 basis points more in increase in the short-term rate over the next year. But my guess is, and I don't know, but my guess is we're going to see those maybe earlier in the year. And then as 23 goes, we're going to wait and see how it affects inflation. Inflation's already coming down. It was over 8%. So what the Fed is doing is working. It's just going to take a little bit of time. Quantitative tightening. So this is taking money out of the system. So the government, we talk about these interest rates, and I know people freak out by this, but the short-term interest rates really have no correlation to mortgage rates. Mortgage rates is what's killing the housing market right now, not the short-term rate. What is going to affect mortgage rates, though, is the quantitative tightening and quantitative easing. So this is the government putting money in or taking money out of the market. So think about the government wanting to take money out of the market. They're going to stop buying treasuries and mortgage-backed securities. So when as loans pay off, they're just going to keep that money instead of pumping it back into the market. So that really reduces demand for mortgages, and that's what drives mortgage rates up. And that's expected. They're taking a ton of money out of the market right now, and they're expecting that to stop in 2023. They being the experts, economists, and those who I follow. Flight to quality. So I'm gonna talk about flight to quality in just a minute, because I want to show you a graph that will help illustrate this, but also the high yield spread. So this graph is going to help me explain both of those. So this is we talk about the short-term interest rates and how it doesn't really impact mortgage rates, and that's true. What does is the long-term interest rates. So this is the 10-year. This is the 10-year Treasury yield compared to mortgage rates, a 30-year fixed rate loan. And so you can see so clear that the correlation is absolutely there. When one raises, the other does. So the reason that's important is flight to quality. So think about as there's fear in the market and you don't know where to invest and you don't know about PFG Fund 5 yet. So you're trying to think, where should I put my money? Well, a lot of people go into the safest investment they can go into. So in a market like we're seeing now, people tend to go into a really safe investment, and that is government debt because it's backed by the government. So you can't get much safer. So as people start pouring money into government debt, that's going to drive the rates down. Higher demand will bring the pricing of those down. So I think we're going to see interest rates come down because of that, but also the yield spread. This is something a lot of people don't understand, but mortgage rates have a built-in, how do you say this, Brandon? You can help me. They're considering factors in the future into the current rates today. So it's like future increases in rates are built into the rate today.
Correct.
And the way you can judge that is by the spread between the 10-year and the 30-year. So you can see, even though it's highly correlated, you have certain times like right here. Can you guys actually see my little mouse?
Yeah.
You can. Okay, cool. So in 1980, you could see when we were going through the savings and loan stuff, and you can see this, how close these came. So mortgage rates in this time period was pretty much no risk at all, right? Because it's paying about the same as a 10-year. And then you see here a big time spread. So they were building in risk here. Now the average is 1.7%. It usually floats 1.5 to 2. So the average, I looked this up, it is 1.7% is that spread. Mortgage rates right now is 6.47 and the 10-year is 3.7. So that's given us a spread of 2.77. So that's telling me that there's a lot of fear or concern built into the mortgage rates. And one of two things have to happen. Either the 10-year has to come up or mortgage rates will have to come down. And I believe mortgage rates will come down. And one of the reasons I believe that is Freddie Mac. So this is the Freddie Mac table for the housing outlook. This is a 30-year rate loan here. And all of these white are actual numbers. All the shaded are predictions from Freddie Mac. So they don't have Q4 done yet. So this is going to be the average for Q4. They think it's going to land at 6.8% for the mortgage rate. And quite honestly, that's looking pretty darn accurate. We're at 6.5 right now, and it was 7. So this is probably going to be pretty close. But you can see the prediction throughout the next year. It's not a huge change. It's going to stay fairly consistent, but you're not seeing a big spike going up either. So you're going to see gradually, they expect interest rates to start gradually coming down. Now, when rates come down, that's going to increase demand for housing, right? Housing becomes a little bit cheaper. And so I think that's going to help with either a softer landing or some type of recovery when that comes. Two other things that I talk about a lot, because I get the questions constantly, and many of you may have seen my reports about the economy or watched the videos on YouTube about the economy and 2008 and 1990, those two crashes, and how I compare those to what we're seeing today. And this holds so true. Like I don't see how we can have a crash like that, because neither of those two recessions that impacted housing had these. So credit is at an all-time high. 760 credit score is a phenomenal score, and 68% of mortgages have that score. And then the other one is the equity. Now, part of this is because of the recent run up in equity, but I don't know that it matters where the equity came from, whether it be from down payments or property appreciation. The fact is that there's equity in homes right now. I think this came from Zonda, which I follow Zonda. They're great. 3% of outstanding loans have an equity of under 10%, meaning 97% of homes out there have more, they have loan to values under 90%. That was not the case in those two other recessions. So we have equity. Equity gives sellers options. They can avoid the foreclosure process. They can sell it. They can refinance it. There's lots of things they can do. All right, now before we go into how to invest, maybe we could take some questions. Brandon, if you're good with that.
Yeah.
And then we'll go through that last slide.
Yeah, so we had one come in right before, and it looks like we've got some starting to flow in now. So I'll give you a couple, and actually I'll just answer this one for you, Kevin, because it's easy. So somebody had asked about the fund growth. So we're up this year 58% from January to date. So that was one of the questions we got. Another person asked, kind of what's our total balance? So we've got about $36 million in the current fund, and we're raising 75 for those that wanted to know. And the last question I had was, let's see, let me look at my notes here. Where'd it go? Oh, when the fund was started. So it was June of 2021. So 2021. So those were a couple of questions, and then I'll take some live from the group here. So we've got one that is, how is Pines lending in Minnesota impacted by the new rent control laws in St. Paul versus developers wanting to build in other states? I've read 70% of residential projects are on hold. So I'll read that one again. That's a lot to unpack. So it's how is Pines lending in Minnesota been impacted by the new rent control laws in St. Paul, Minnesota, sorry, versus developers wanting to build in other states? I've read 70% of residential projects are on hold.
Yeah, so that's a great question, and that's a difficult one to answer, other than it hasn't impacted us. I guess it's easy to answer. It hasn't impacted us, but the reason is what you're looking at is like the production builders. So there's a lot of build to rent builders out there, and they wouldn't look at St. Paul, for example, or probably most of California, because there's too much government involved. And I get it, but we're talking about mom and pop investors here, and most of them are fixing and flipping anyway. And I got to be honest with you, we're seeing a lot more transactions outside of St. Paul and Minneapolis. We're not seeing clients want to be in either one of those cities. So most of ours are in the suburbs anyway. So we haven't seen any impact to that.
Yeah. Okay. Next question we got are, somebody asked, what are the other funds? So for those of you who are not aware, this is our 5th mortgage fund that we've raised here at Pine. And so we had 4 previous versions, and this is our latest and greatest. And this one's a debt fund as opposed to the other ones that were structured. And what I mean by that is when you invest into our fund, you get a promissory note. So Kevin kind of covered that at the beginning, which is it ends up being a debt obligation to the fund, right? You are loaning the fund money. All right. And then the one last question I also had, Kevin, which was really somebody had asked, what's a bad day for the fund look like? What if I get this question all the time? People say like, well, what happens if real estate values, really, go crazy or whatever it is? What does that look like? And so I thought we would kind of pose that to you while we got you on the webinar.
Yeah, I'm happy to jump in, but do you want to tell me what you think, and then I'll share.
Yeah, absolutely. Yeah. So, I get this question quite a bit. And, one of the things that we talk about is like, if you really look at how Kevin just brought back up, how we're diversified across different asset classes. And I think that that's one of the things that gives us a lot of strength, right? The idea is that, we're lending on different, types of real estate to make sure that we're not overly exposed in one group. And then I always tell people, if you really look at our underwriting standards, the fact that we're only willing to go up to 70% of the after repair value, prices have to like come down a lot for us to really be impacted, because the idea is that you have a 30% margin in there. So we're trying to build that in. And then I know, we as a management team, myself, Jared, Kevin, constantly looking at underwriting standards to say, do we need to tweak this? Do we need to get more conservative? And so that's something that we're always evaluating. And then the last step, and you talked about this a little bit earlier, is, these are 9-month loans. So whenever I talk to potential investors, I want to remind them that we're not in these loans for long. So, we look at this as like, our money is constantly turning over, right? We're constantly making new loans, and loans are constantly getting paid off. And so, we feel like we're in a good position to avoid any kind of like drastic change where if the market really went sideways, we have levers that we can pull to say, okay, hey, one, we've got a lot of equity in the deal. And then number two, a lot of those loans will be closing out. So it would have to change in a drastic fashion and very fast pace for us to really get, sideways, I would say. So I don't know if there's something you want to add to that, Kevin.
I think you did a fantastic job. I'll just add that I've been through multiple recessions. I went through .com. I went through 2008. I was lending money in 2008. What I understand about underwriting and managing a portfolio is to look at the worst case scenario. What happens if they don't make their payments? What happens if the value drops and they can't sell the house? What if it happens to a big chunk of the portfolio? And we protect ourselves from that. One, from diversification and locations. I know real estate is very location specific, even if interest rates impacts everything. So we're trying to stay diversified in that, but also be heavily weighted in cash flowing properties. Like all of these commercial, most of this residential, we could just rent out and become a property management company. Absolute worst case scenario. But even in 2008, I didn't do that. We still made our way through that without any headache. In fact, I will say this, Brandon, I don't even know if I've shared this with you. We've held one property as a rental one time. Almost 2,400 loans we've done. One time I decided to hold it for a rental, and we did it for like 2 years, and then I sold it. But that is an option that we have if it gets that bad.
Yep, makes sense. We just got another question. It was, can IRA money be used? So we get this question all the time. I always tell people, yes, but it has to be a self-directed IRA. So if that's something, typically your larger IRA companies, your Fidelities or whatever it is, don't typically allow you to do it. So it's got to be a self-directed, and we know of a couple. So if those are questions you have, we can always get a couple names to you, and happy to help on that front.
In fact, this is so perfect for IRAs because you could reinvest it, right? And you don't want the money if it's in your IRA anyway. You want it to grow. So this is one that you could just reinvest and let it grow. Compound interest, eighth wonder.
Yeah.
So I put up the rest of this slide just so that everyone can see it. So it's just a $10,000 minimum. The prospectus says 25, but with all the volatility in the market, we talked as a leadership team and decided to lower it to 10 to try to help more people. I was resistant to that because oftentimes we have the lower investment amounts. Those investors tend to call us more, they're a little bit more worried about things. So I was trying to avoid some of that management hassle, but I think we're staffed up properly now, and we really want to help investors that are trying to add stability. IRA, non-IRA, we just talked about that. Accredited, non-accredited, we talked about that. You just got to decide if you want income or growth, and then get the prospectus. So Brandon can help with that.
Yeah, it looks like we had a couple more questions flow in, and somebody asked, how is the 8% paid? So it's annually. What we do is it's 8% annual, and then we pay out monthly, so you get quarterly statements. But I always like to say it's, you know, on an annualized basis, it's not 8% monthly. That would be a lot. That'd be quite the investment. But and then somebody else asked if after you invest, can you switch between income and growth? Yeah, we get that quite a bit. You know, obviously we want to be careful and not, you know, constantly changing. But, you know, one of the biggest things we say is we don't want it to be treated like a checking account. But yeah, you know, if you decide you want to leave it to compound and grow, we get that, and then change your mind to receive distributions. That's something that, you know, we can do as well. And then, you know, we have a 90-day notice period in terms of just letting us know. So give us a heads up if you're going to be withdrawing the funds, so that we can kind of work through it accordingly. And the other thing is, you know, if you want to split the fund, you know, basically split your investment, have some compound, some receive distributions, we can do that as well too. So I wanted to kind of put that out there as well. All right. One last question as we get through it. Somebody said, is there a minimum time frame we need to invest this money with the fund? Yep, I think I covered that one. So it's, you know, we don't have any lockup periods, but we do ask for we do have a 90-day notice period that we can return the funds to you.
All right, I'm going to do a stop share so I can just see everyone's faces.
Yeah, and Diane, I see that you have your hand raised.
Yeah. So if everybody here puts in $10,000, let's say, it all goes into one big pot, not into an individual property, right?
Correct.
Yeah.
Yeah,
And I think that's a huge advantage. So when I started Pine in 2008, all I would do is individual loans for individual investors. And then, you know, back then you could get into a loan for $100,000, but you can't really do that anymore. But in 2009, we decided to start the first fund because of 3 reasons. The feedback was, we need diversification. This is too risky. If a borrower defaults and I'm on all in one loan, then I don't get interest payments. I wanted some liquidity, and I need a smaller investment amount. So because of those, we started the fund, and that diversification is really where it's at.
Okay. I got a couple more questions. We'll keep going here. So we got one says, how does our business model compare to Fundrise and similar companies? I don't want to speak to that offhand. I've got the website pulled up, but let me do some due diligence on that. I don't know, Kevin, if you've heard of them, but that's not something not a company I've run across.
Well, Fundrise raises money for other projects. They raise money for syndications primarily. So you're going to be investing in somebody else's project, not Fundrise's project. And you're invested in that specific deal for them. So it's what's a benefit to this. You're not going to get the high returns like you might find on Fundrise. But the difference here is we're debt. You're going to be invested in a first position loan with us servicing it. So there's someone between you and the actual user of the money. So I believe it just creates a little bit of a little more layer of protection.
Another one just asking about the PowerPoint being available after the meeting. I know we recorded this, so I think, you know, what I'd like to do is actually, I'm gonna, for anybody who, you know, wants to get this recording, I'm happy to share it. Probably need to do some editing, maybe take me out, just kidding. But yeah, we can make it available, and, you know, we'll take a look at the PowerPoint deck as well. We're reluctant, you know, historically, we don't normally provide PowerPoints just because information changes so fast that we don't like leaving stale data out there. So that's why I prefer a webinar if I'm, you know, if we're going to go down that path. And then somebody asked, when will the fund close? As fast as we raise the 75 million. So you guys help us, we can do that in the next couple of weeks.
Yeah, if you guys don't mind, if you're still listening, turn your camera on. I'd love to see you. There's a lot of familiar faces. Heidi, David, Sean. There's a lot of people on this call. I really appreciate you all. Love to see your face.
And we're getting some comments coming through. People saying it's great to see you. We have, how many staff do we have? We'll be at 13 in the start of the year. And then the 8% interest rate, it's a flat 8. So, you know, that's how that works. Any other questions from the group? All right. Well, really do appreciate all of you taking the time to join us tonight. For those who are aware of it, we had a few issues with people getting into the Zoom meeting and the webinar. So another reason why I'll push out that's on me, Kevin. Gave you the host, but couldn't see the people waiting. So if you hear from anybody, please let them know, reach out to us. We will share the recording, and we want to make sure everybody who wanted to be here can see it. All right.
Appreciate
Thank you,
all.
everybody. Have a good evening.